Jollibee Company was founded in 1975 by Dr. Toniton Kakyong. With the help of his wife, Grace, his family and in-laws, they started everything with a family business, selling ice cream in the street of Manila. 3 years after starting, the family saw the opportunity for hot meals. They converted the ice cream parlors into the Jollibee brand we know today. And now, always saw the huge potential for his business and dream by. He put faith in hard work, passion, and focus to turn his them small business into one of the highest companies in the Philippines, Asia, and now in the world. Jollibee Foods Corporation, also called JFC, the popularly known as a Jollibee, is a Filipino multinational chain of fast food restaurant headquartered in Pasig, Philippines.
Jollibee financial statements in year 2021. Revenues. Gross sales 146,496,331 pesos. Sales discount 13,909,895. Net sales 142,586,436. Royalty, set-up fees and others. Note 20, 8,710,309. A total of 151,296,745. PFRS 15 impact on system-wide advertising fees 2,278,845. A total of 153,575,590. Direct cost, note 21, 127,496,679. Gross profit 26,078,911. Expenses, general and administrative expenses net, note 22, 16,473,091. Advertising and promotions, 3,331,207. A total of 19,804,298. Interest income expense, note 23. Interest income 164,167. Interest expense 4,145,749. A total of 3,980,782. Equity in net earnings, losses of joint ventures and associates net, note 11, 43,423. Other income net, note 23, 3,893,018. Income loss before income tax 6,143,426. Provision for benefit from income tax, note 24. Current 2,029,364. Deferred 1,387,929. A total of 641,435. Net income loss 5,501,991. Other comprehensive income loss. Other comprehensive income loss to be reclassified to profit or loss in subsequent periods. Translation of adjustments of foreign subsidiaries 1,490,782. Translation adjustments of foreign joint ventures and associates, Note 11, is 110,257. Comprehensive income loss on derivative liability, Note 18, is 128,685, a total of 1,509,210. Other comprehensive income loss not to be reclassified to profit or loss in subsequent periods. Remeasurement gain loss on pension net of tax, Note 25, is 260,306, a total of 1,769,210. Total comprehensive income loss is 7,271,507 pesos. Net income loss attributable to equity holders of the parent company, Note 28, is 5,981,690 pesos. Non-controlling interest is 479,699, a total of 5,501,991 pesos. Total comprehensive income loss attributed to equity holders of the parent company is 7,930,344 pesos. Non-controlling interest is 658,837, a total of 7,271,507 pesos. Earnings loss per share for net income loss attributed to equity holders of the parent company, Note 28. Basic 5,302 pesos. Diluted 5,293.
In cash equivalent is 24,692,675 rubles plus short-term investment of 79,700 plus financial asset at fair value through profit or loss of 14,412,902 plus receivable and contract asset of 7,245,986 plus inventories of 935,329 plus other current asset of 9,595,475, and the total current asset is 66,382,067. Non-current asset, financial asset at fair value through profit or loss is 400,232 plus interest advance to joint venture co-venture of 15,426,603 plus property, plant, and equipment of 30,608,819 plus right of use asset of 38,168,366. Investment plus trademarks, goodwill, and other intangible asset of 50,610,888 plus operating lease receivable of 55,532 plus financial lease receivable of 56,674 plus deferred tax asset rate plus of 6,874,855 and other non-current asset of 3,614,191 and And the total non-current asset is 145,456,160. And the total asset is 238,222,22.27. Liabilities and equity. Current liabilities, trade payable and other current liabilities and contract liabilities of 32,952,755 rubles plus income tax payable of 148,617 plus certain debt of 510,000 plus current position of lease liabilities of 7,284,154 plus long-term debt of 4,950,565 provision, and the total current liabilities is 45,846,091. Non-current liabilities. Senior debt securities of 30,426,149. Non-current position of lease liabilities of 35,899,523 plus long-term debt of 17,409,612 plus interest in associate of 179,088 plus pension liability of 2,416,465 plus derivative liabilities of 12,075 plus provision of 1,335,636 plus deferred tax liabilities rate of 3,428,713, and the total non-current liabilities is 90,807,981. Total liabilities carried forward is 136,654,077. Attributable to equity holders of the parent company. Capital stock preferred 12 million. Common rate of subscription receivable of 1,107,164 plus additional paid in capital of 10,331,342 plus other reserve of 1,877,400 plus cumulative translation adjustment of foreign subsidies and interest in joint venture and association of 1,082,109 plus remeasurement loss on net defined benefit plan rate of tax of 1,140,807 plus comprehensive loss on derivative liabilities of 12,795 plus excess of cost over the carrying value of non-controlling interest acquired of 2,226,340 plus retained earning plus appropriated future expansion of 18,700 plus unappropriated 13,863,187 equals 55,782,060 less cost of common stock held in treasury of 180,111 equals 561,549 plus senior perpetual securities of 20,264,804 plus non-controlling interest of 1,682,181 88 equals 74,184,155 and the total equity is 210,838,227 rubles.
So, I discussed the financial ratios in the Jollibee Food Corporation. So, we have the table of financial ratio of year 2021. We have liquidity ratios and formula, the importance or usage, solution, and interpretation. First is quick or asset test ratio. So the formula of quick asset test ratio is quick assets divide current liabilities. The importance or usage of the quick ratio is essential for evaluating a company's financial stability and risk since it shows how well positioned it is to weather short-term cash shortage by allocating its most easily convertible assets. So the solution is equals 31,938,661 divide 45,546,091 equals 0.70%. So the interpretation Jollibee have 0.70%. It means that there are 70% assets readily available to pay every peso of liability. Second is current ratio. So the formula of current ratio is current asset divide current liabilities. So the importance of the current ratio, it provides investors with a brief overview of a company's liquidity and possible creditworthiness by demonstrating its capacity to pay down short-term loans using easily accessible assets. So the solution is 65,382,067 divide 45,846,091. The total is 1.43. So the interpretation, Jollibee have a 1.43 current ratio, which means that for every peso of current liability, there is 1.43 peso of current assets can be allocated for. So the third one is total asset turnover. So the formula is sales divide average total assets. So the importance of total asset turnover is higher total asset turnover shows the company efficiently squeeze sales from its resources, making it attractive for investors and creditors. The solution and answer is 146,435,331 divide 210,824,179. So the total is 0.70. The interpretation is the asset turnover is 0.70%, which means that the business is efficient and effective in utilizing their assets to generate sales. Next is inventory turnover. So the formula is cost of sales divide average inventory. So the importance or usage, the businesses may enhance cash flow, optimize stock levels, and make well-informed decisions on pricing.
production, and marketing by keeping an eye on inventory turnover. So the solution is 127,496,679 divide 8,825,579. So the total is 1.43. The interpretation, the inventory turnover is 1.43, which is above the standard, which means that the business has liquid inventory. They are able to sell more inventory within the normal operating sales. Next, times interest earned. So the formula is income before interest and tax divide interest expense. So the importance, time interest earned reveals a company's debt juggling ability. High tie signifies smooth repayment, while low tie screams potential financial struggle. This quick snapshot informs investors and lenders, helping them make smarter financial decisions. The solution and answer is 6,143,426 divide 4,145,749. So the total is 1.48. So the interpretation, the company pays its periodic interest expenses 1.48 times throughout a normal operating cycle. Next is debt ratio. So the formula is total debt divide total asset. So the importance of debt ratio, it reveals a company's financial health. A high ratio indicates vulnerability to debt burdens, while a low ratio suggests stability and potential for growth. Analyzing this ratio helps assess risk and make informed investment decisions. The solution is 136,654,072 divide 210,836,227. So the total is 64.81%. The interpretation, 64.81% of Jollibee's assets are funded by debt. It means that the business is riskier to invest in. Next is return on equity or ROE. So the formula is net income divide owner's equity. So the importance, ROE tells investors how well a company uses their money to generate profits. High high ROA means more bang for their buck, making the company a sweeter investment proposition. So the solution, 5,501,991 divide 74,184,155. So the total is 7.4%. So the interpretation, the business produced 7.4% of its sales from its net assets. Next is return of assets or ROA. So the formula is net income divide average total assets. So the importance of ROA reveals how efficiently a company turns its assets into profits. Higher ROA means more juice squeezed from each orange, showing strong management and potential for investor delight. So the solution is 5,501,991 divide 210,824,179. So the total is 2.61%. So the interpretation, it signifies that the business gets a 2.61% return on every assets it owns. Next is fixed assets turnover. So the formula is sales divide average fixed assets. So the importance of fixed assets turnover, it measures how efficiently a company uses its long-term investments to generate sales. A higher ratio suggests better utilization, boosting profitability and potentially indicating a leaner and more efficient operations. So the solution, 146,435,331 divide 56,129,091. So the total is 2.22%. So the interpretation, it shows that the business is not so efficient in utilizing their fixed assets in generating sales. Lastly, gross profit margin ratio. So the formula is gross profit divide net sales. So the importance of gross profit margin ratio is higher gross profit margin, more profit per sales. It shows efficiency and potential for growth. So the solution is 26,078,911 divide 142,586,436. So the total is 18%. So the interpretation, it means that the business does not have a higher gross ratio, and it indicates a low capacity of business to earn more profit.